Hi, welcome to this video today, which is all about Forex money management rules for success. Now, in terms of this video, I want to go through 10 rules or tips, and if you incorporate them in your trading strategy, they'll give you a solid foundation in terms of minimizing drawdown when it occurs. And when you have a drawdown period, which is obviously inevitable, you will recover it in the right way, reach a new peak in equity without getting frustrated, angry, or stressed out. And that is what happens to most traders. When they get into a drawdown period, they handle it totally the wrong way and basically blow their trading account. Now, in terms of the rules and tips, they're very simple to learn and apply. And if you do put them in place, they give you a solid foundation to seek consistent profits long term from the market. So I've written them up on a storyboard. So let's go and take a look at them in more detail. All right, let's go through the 10 points. Now, in terms of point number one, it's very important for beginners to understand, have realistic expectations from the start in relation to drawdown distribution, how long a drawdown will last. Most beginners do not. They come online, they read about making regular monthly incomes, 100 pips per day. They see people presenting equity curves that just kind of an exponential straight line, and they think that drawdowns, are not really going to be too long or a problem. Now, in relation to this, if you want the reality, all you do is go and look at great traders, and you can look at any great trader you want. George Soros, Ray Dalio, Paul Tudor Jones, and if you look at their track records, you'll see a month of drawdown is frequent, and all the great traders at some point will have a drawdown of 3 months. Okay, if you trade long enough, you will hit that sort of long drawdown period. And if you tell beginners this, they get disheartened or they don't believe you. Okay, but just do your research. Okay, just look at the great traders' track records and you'll see what I'm saying is true. Now, it isn't something to be disheartened about, because when you trade Forex, you judge your performance over the longer term. You don't judge it over a month or 3 months. You judge it over a year or more. And you can see all the great traders know how to deal with drawdowns, and obviously they all made great profits over time. You can too, but you've got to be realistic and understand those drawdown periods are coming, and you will face a long one. You've got to minimize the drawdown. Okay, if you're prepared for it, that means you won't get frustrated, angry, stressed out, do the wrong things, and your discipline obviously breaks down when your emotions come into play and you do the wrong things. You need to do the right things in a drawdown period. Okay, now before we talk about dealing with drawdowns, you don't want to fall too far behind, do you? So what is the optimum exposure in the markets in terms of risk to give you decent profits, but ensure you don't fall too far behind? Well, in relation to this, you can just go and look at the Kelly formula. It's a mathematical formula. I'm not going to go through it here in detail. You can look it up online, but it will give you your chances of ruin against your risk exposure in the market. And if you go above 10% significantly, your risk of ruin is high. So just in terms of our strategy, we'll normally be about 5 or 6% if everything goes wrong. That's what we're going to lose in the markets, and we will go up to 10% if we have a profit cushion and we see a really standout trading opportunity that matches our trading strategy. Now, most beginners, they'll trade maybe 10% on one trade or 20%. Seen this frequently, and you could be lucky, but your luck will not last for long. Okay, if you want to be in the game long term, you keep your exposure to a level that doesn't make you fall too far behind. Now, in terms of a lot of traders, they actually think, well, you know what, I could do a few trades, and if I lose one or two, then the others will probably balance out the losers. That is totally not a good thing to do, because if one trade can go wrong, they can all go wrong. It's been statistically proven that diversification does not reduce risk. So you need to be very careful about your risk exposure in the markets. Now, in terms of drawdown, when it comes, what levels should you be concerned about? Okay, for us, 10% drawdown, pretty normal. If we get near 20%, then we kind of get concerned, and we will cut back size. We do not want to be 30% behind. But in terms of most beginners, when they fall behind, they're either going to keep the same exposure in the markets, or even worse, they're going to increase it to get the drawdown back quickly. And this is Buffett's hole, where Warren Buffett said, if you do that, you just dig yourself a bigger hole, and eventually you'll wipe out your accounts. You need to cut back your trade size and get the drawdown back in stages. So if we're, let's say, just above 20%, we'll aim to get to 15, and then we'll aim to get it below 10, and so on. Okay, so we'll come back slowly. Now, in terms of trying to hurry, in terms of getting a drawdown back, it's just not a good idea. Okay, it's the most common error that beginners make. Always keep in mind, the further you fall behind, the more work it is to get that drawdown back. So if you fall, let's say, example, drawdown of 50%, you've got to get 100% gain to get back to break even. So don't fall too far behind. Now, in terms of when you hit a drawdown, you cut back size, you become more patient. Okay, that's what professional traders do. They know the safest trade in FX most of the time is what? It's no trade, isn't it? Because you can't lose any money. Okay, so you need to be very selective in your trades. Now, you need to know also, if you've got a trading strategy, your edge related to trading market conditions. A lot of traders don't know why they're losing. That's because they don't know the edge. We will know, of course, any trade can go wrong, but we will be able to spot trading conditions that do not suit our trading strategy. And an example would be, I think it's from most professional traders, when you've got very low volatility and choppy sideways action, there's no point in trading. You want to stay away from those sorts of pairs. Okay, I think you need to have an edge. You need to have researched it yourself, not just take someone else's strategy and assume it's got an edge. You need to know why you win, why you lose, and why that edge will prevail over time. Okay, now in terms of when beginners hit drawdown, they very often fall for what's called sunk cost fallacy. So say they're in a trade, let's say, for example, it's GP USD. They've lost money on it, significant money, maybe on one trade or a few trades. They will focus on that pair to get something out of it. It's very personal. Okay, they could, if they didn't let their emotions get involved, look at other pairs which would suit their strategy better, but they're focused on one pair. I think sunk cost fallacy comes in life a lot of the time. I mean, have you ever been to a movie, for example, you're halfway through, it's rubbish, but you're going to sit through to the end because you want something from your trip to the cinema and your ticket price. It happens all the time. Now, in terms of sunk cost fallacy, that is revenge trading, which I've written down. But revenge trading is a general concept, obviously. And traders just think the market is out to get them generally. It's literally out to take money from them. So they personalize the market. As Bruce Kovner, one of the great traders, said, if you personalize the market, you cannot trade. You will not make money. Your emotions will dictate your trading decisions. They will. Okay, the market is just there. It's up to you to make money from it. It doesn't like you and it doesn't dislike you. M&S is the make no sense trade. And what I mean by that is traders are in a trade. Suddenly goes the opposite way to which they think it should go. And they think, well, this makes no sense at all. I'm going to hang on to it or double it up. If the trade makes no sense to you, then you shouldn't be in it. Okay, you can get out with a small loss probably. If you stay in the trade and it makes no sense, you'll probably get a bigger loss. So if you don't understand the market conditions, just get out. Okay, leads on next to prospect theory. It's a theory by Daniel Kahneman, award-winning Nobel Prize winner, actually, in terms of psychology, and he put forward the theory that as people, we hate losing twice as much as we like winning. Okay, you can go and read up the whole theory, but it's obvious what this theory does to you when you're trading. You've got a loss, you've had quite a few losses, maybe you're in drawdown, you keep getting stopped out, so just give that trade a bit more room to breathe, so to speak, move the stop back. Obviously not a good idea. And on the other side, any profit will do. Taking a profit makes traders feel good, even if it's tiny, okay? But of course, if you snatch the profit, you're not going to cover your losses, which potentially or possibly a trader might be running. So it's that well-known advice in Forex trading: cut your losses and let your profits run. But of course, when emotions get involved, traders know they're doing the wrong things, but they just do them, okay? The emotional side of them is dictating their trading decisions. Now, in terms of mindset, obviously, if you're stressed, you're angry, frustrated, you will do the wrong things, okay? And you will have the impact of steroid hormones as well. And there's two. I've written frequently on steroid hormones and how they affect your brain in other videos, but the two that are important are testosterone and cortisol. Now, testosterone, if we're dealing with money, okay, and this has been psychologically proven, it generates a testosterone response. We want to fight to get money, okay? And that comes into play when people go too far behind, or traders go too far behind. They'll fight quickly to get the money back, okay? Testosterone is impacting on their brains, okay? Now, I know I covered that point earlier, but I would strongly recommend you read up on steroid hormones. They have a heavy influence on you and your thinking. Cortisol is the other one. If you're losing, your confidence will naturally drop. You'll be getting stressed. You'll be getting frustrated. The body, in response to stress, basically generates cortisol. Cortisol drops your confidence, okay? So you just can't do the right things, okay? Anyway, read up more on steroid hormones. But when you get into a period, and I think all traders have had this, just nothing will go right for you. And trading is, a stressful business. Have a break. Trader Vic Spirandier, one of the great traders, said this, it's best to walk away from the markets, have the break, and then you come back, kind of and see the markets in a different light. But most traders will not walk away from the markets because they think, if I have a break, I'll miss out because everything I wanted to come true will probably come true when I'm not trading. Well, that might happen, but the markets are going to be there. When you come back, there'll be great trades to be had. There'll be drawdown periods. So having a little break, I think, is a good idea. A few days or a week or something like that. Okay. Now, all great traders know the wise old Scottish saying. And what is the wise old Scottish saying? It is mind the pennies and the pounds will look after themselves. Okay. Which is pretty obvious what that means. Control your losses. Keep them small. Don't let them run out of control. And of course, your edge will prevail longer term. There's a great quote from hedge fund trader Larry Hite in relation to this, where he says, if you want to win, you've got to bet and you have to be at the table. But if you lose all your chips, you can't bet. And that's what happens to most traders, isn't it? They lose all their chips and blow up their accounts. So if you want to trade Forex longer term, you want to take Forex trading seriously. The 10 points that I've just gone through will help you in terms of minimizing drawdowns, coming back from them to a new peak in equity, and also holding your discipline and not letting your emotions get involved. Right, that is the video for today. Hope you enjoyed it. Thanks for watching me as per usual. Take care. Have a good day.